guys, Tricia Turner here. It's Tuesday. This is Walk Away Wealthy. What are we doing? This is every Tuesday, 12 o'clock Central. We're bringing you a message of positivity, to help you grow your business, to improve your life, anything all positive. Running now on our third year of doing this consistently, which is super awesome. And every week we're bringing you somebody new. And so this week I've got a really cool guy. I've got Jose, who I just met a short time ago, but he's got a lot to talk about and he's been doing this business for a long time. So I'm excited. Welcome, Jose.
Oh, thank you, Tricia. It's a pleasure to be here.
Heck yeah.
Such a pleasure.
So first of all, we're going to talk about the real estate market. Everybody is wanting to know, like, what is going on in the market? What's going on with interest rates? What do we think is going to happen? And when you listen to the news, it can be like doom and gloom. The sky is falling. And you listen to like everything is a generalization. And I thought, you know what? I know people all over the United States and the world. Why am I not bringing somebody on every week so we actually can hear from you, like what's really going on in your market instead of the news? So Jose, if you could, let's do a little bit of a backstory, like tell everybody where you are in the world, what you do for a living, and how long you've been doing that.
Okay. My name is Jose. I am a mortgage banker based out of Los Angeles. I'm sitting in my Beverly Hills office right now. I have licenses in 5 states: California, Washington, Colorado, Nevada, and Florida. My largest markets are California and Florida. And I've been doing this for a long time. Overall, I've been in the finance industry for 23 years. And prior to just jumping straight directly into having a mortgage practice, I used to be a wealth manager at a private bank here locally. So I have a background I had all my investment licenses. I only have one now, but I did all that and helped affluent families manage their businesses, basically.
Which is insane. Like, that's a huge role that you have. You're there in LA. Have you always been based out of LA?
Well, I came to the United States when I was 10 years old from El Salvador. And so I get here via an amnesty program. So I say that I always tell this fact, which a lot of people don't know. Because of the program, you can either land in Canada, the United States, or Australia. The second largest population of Salvadorians in the world is in Australia, which is something that a lot of people don't know.
No.
Google it. I challenge you. It's there. And so we land in Queens, New York. Eventually, the rest of the family comes. They come to California, Southern California, and we kind of unite. And I've been here since I was about 11 and a half years old. So, yeah.
Wow. And then you've got 5 licenses. And y'all know I'm in Texas. And so I asked them, like, why not Texas? Talk to us about, like, what was the goal in getting so many licenses and why not Texas?
Yeah. So when I left private banking and I wanted to really go dive deep into lending, and the reason why is because I was always a lender by nature. I started at a bank that doesn't exist anymore called Washington Mutual.
Oh my gosh,
Washington Mutual, it was a national bank. A lot of people knew it, and it was really the only actual victim of the 2008 crash. Other banks obviously suffered. Everybody suffered, but that one got wiped out completely.
Yeah.
And so it was a savings and loan. So my background was always in that and that structure. And it's what I've been really good at and passionate about for forever. And so when I left, I wanted to do that. And leaving sort of the restraints of a bank, I wanted to explore as much as I could. And I tried to start with my neighboring states, which is why Nevada, Colorado, and ultimately went to Florida because I had my sister move there. And I wanted to help her buy her home and do her financing. So I got a license because of that. And then I quickly developed relationships and started growing a business there.
So in 2008,
largest market.
Yeah, which is crazy. I remember Washington Mutual. I was a lender from 2004 to 2010. So I remember all of that stuff. When that all happened in 2008, were there any signs like, that people talk about these signs you saw it coming? What's your thoughts on why we led up to 2008? And did you see signs of that coming?
That's a great question. And I do a lot of public speaking about this. So let me get out the first thing is what we're going through now is absolutely nothing compared to 2008. It's not it at all. So what happened in 2008 was a free-for-all, no regulation environment, and a free-for-all mantra about just buy a home, right? Everybody needs to buy a home. The reality is that while buying a home and having home ownership is a great wealth builder, if you don't have the capacity to buy a home, you shouldn't be buying a home.
Yeah.
And so what happens is the financial system creates an environment where all you need to do is be alive and you can qualify for a loan. Like you don't need to prove anything. You don't need to have any record. You don't even need to have any effort in saving money to buy a home, right? So think about it. Today we have a minimum of 3% if you're doing a conventional loan that you need to save for a down payment. That it wasn't even that, not even 3%. And if you might remember, Tricia, there were loans, especially done by WAMU and others like WAMU, that were 110% loan to value. That's illogical.
Yes.
I was a very young man at that time. I didn't understand economics like I do now. But 110%, I mean, you're starting negative 10% on your home.
Yep.
That's something that will never be seen again, and is absolutely not seen today. Regulation is a lot tighter today than it's ever been before to qualify for a loan. And really what we're going through now is a consequence of more like of a natural disaster than it would have been a systematic problem. Back then, the system was broken. In fact, I didn't need a license to do the loan back then. Nobody had a license to do loans, right? The whole, think about it, it's pretty wild. The whole United States, you're dealing with people savings and money and biggest expense, and you didn't even need to be licensed for it.
Wasn't that crazy?
Right? Something that today in 2023 we wouldn't even fathom. You can't have a license, have a continuing education, and have your background checked. That never existed prior to crash.
No.
And so you have a lot of irresponsibility in the market as well.
Yeah.
Because the money was quick and easy to make, and there wasn't any regulatory barriers.
Okay. And then we go through the 08 crash and things are grim, 8, 9, and 10, especially here in Texas. They were in foreclosures were like everywhere.
Oh, everywhere. I lost homes. I lost 2 homes.
Really?
Yeah.
You know what we saw here, and I don't know how it was in California, but here, property values plummeted, of course, and nobody could pay for anything. But of course, like you just said, they were starting a home with no equity at all, and negative actually a lot of the time. And I can remember that because there was even loans that we would do. It almost became like a joke to see who could get somebody the most money back at closing. It's like, and again, I was like you, I was like really young too, so I didn't understand all of that dynamic. It's like, that was really stupid, you know?
Yeah. Yeah.
And
absolutely.
then we went through
and I don't, I struggled with that for a while. And then now, I think we got to be more forgiving of ourselves because the system was just broken. The system didn't work and it wasn't protecting the consumer at that time.
No. And then we went through this long era of like really low interest rates, sometimes under 3%, which is like unheard of. People that have like a 2.2 interest rate. Now we're in a time where I think I even heard on a podcast either this morning or yesterday where interest rates are higher than they've been since the year 2000, which people are freaking out. Talk to us about that. Yeah.
So what's important to understand is that, and because we lived through these rates, these low rates for a couple of years, let's call it 2.5 years, the consumer, people, us, became accustomed to those rates and believed that those were normal. That was absolutely not normal. That was a once in a lifetime experience. You've been in the business a long time. I've been in the business a long. We know that will never likely happen in our lifetime again. It's extremely an anomaly. And what happens is, and I won't get into the whole detail of it, but in a nutshell, in a macro way, we get a COVID-19 pandemic. I mean, it is zombie apocalypse fear, right? Yeah. None of us know what it is. We don't know what's happening. And everybody, including the markets, are spooked up by it, right? They're spooked. So the government steps in and they become the largest buyer of the secondary market of mortgages. Right. And so when that happens, it creates a lot of safety because daddy government's going to buy it all. So that's what makes the rates completely go down and drop. Well, after a while, the opposite of that happens. After a couple of years pass, the government starts to pull back and stops buying as much of the secondary market. And when that happens, and it was planned, that was part of the idea, that was part of the government influence. When that happens, then the market starts to return to normality. But now it's all disrupted. And that's when you see our rates continue to go up and you see inflation start to skyrocket as well.
So going through all of that, now here we are in 2023, headed fourth quarter now, you're in a bunch of different markets. What have you seen that do to the housing market in all of these different markets?
Well, and speaking of podcasts we've heard, I just heard it on my way in today. And it said the gentleman said, the market we knew will never be again. And that's I believe the reality. I don't think that you can base much on history right now, because what we've gone through, starting with COVID and going into the economic environment that we're in today, hasn't really been seen before, not at this speed. So the biggest complexity is that it's so fast.
Yeah.
And to be in a situation where you have, 7.5 whatever percent rates on mortgages, but you also have no inventory at all.
Yeah.
That's unique in itself, in a bad way, but unique in that it hasn't really happened before as well. So the housing is tough because the inventory is a problem. So if you add more inventory, then you go back into a simple supply and demand issue, right? You have to lower the prices, but there is no inventory. So prices stay elevated. And then there's still high inflation. So interest rates are elevated, making it very difficult for a lot of buyers to get into the market today. Now, it's not to say there is an opportunity. As you know, there's opportunity in every market. The opportunity here is that if you can qualify for a mortgage, you're probably going to be able to negotiate better, because there's going to be less people being able to qualify for a mortgage. And it's going to happen in two ways. One, they may not qualify, just they may want to but can't. Two, they can but don't want to, right? And so if you are in a capacity to be able to qualify for a mortgage and want to, then you're going to be with less competition. Because, as I've said many times in other shows, houses aren't built out of thin air. No. And eventually rates will come down, and eventually inflation is going to come down. That's the government is doing everything possible to try to make that happen. But when that happens, competition is going to increase and jump higher. But houses don't appear out of nowhere, right? Yeah. So there isn't, I don't think, a fear of I'm going to lose value in my house. I don't think that's a fear, because I know that when rates drop, competition goes back up. Therefore, again, supply and demand, houses get priced higher. But there is an advantage of refinancing to a lower rate in the future as inflation tapers down.
So we've heard a lot of real estate and lenders talk about what they think is coming. And a lot of people believe that when rates come back down, because they will, don't know when, but when they do, it's likely, because we're still in such an inventory shortage, that we could see another repeat of bidding wars, people paying over list price, 20, 30 offers on a property. What's your thoughts about that?
Yeah, absolutely. So if you remember last year, right about this time, we saw a lot of opportunity for buyers.
Yeah.
Because we thought it was a crazy rate of 6.5%.
Yeah.
Right. So what happened was the sellers started to think, well, how high is this going to go? I better give concessions. I better allow these 2-1 buy downs. I better allow these 3-1 buy downs. I better give credit towards closing, because I may not have a buyer in the future. Right. I think we're literally going to see that in an enhanced level at the end of this year. The rates have been climbing, but I think the same thing happens. I think that a seller's mindset is going to be, well, how much higher are they going to go? And remember, the mantra of the government as of the last Fed meeting, higher for longer, is really what they're saying, right?
Yeah.
Higher for longer means that, and that comes out of the release of the dot plot map that they put out, basically saying what they predict the future is going to be. And so they essentially believe that there are not going to be any rate cuts in the 2024 year. Well, originally they had thought they would do rate cuts in the 2024 year. So even though they might not do many hikes, the fact that they're not going to cut essentially means higher for longer. So a seller might feel that that's going to eliminate so many more buyers. I better sell today if I need to sell today.
Yeah.
And I think you see opportunity between now and December because of that.
So when you listen to these messages and you listen to their forecasting and all of that, do you really believe that interest rates will not come down in 2024?
No, I think that we're going to, my personal opinion, listening to a lot of economists and my knowledge, I think that we'll see breaks around summer of 2024. And the reason I see that is because, and here's what you're going to know. And then really, this is what I think is the tea leaf. We need to have a sad Christmas to have a happy summer. Okay, what does that mean? That means that if spending goes down at Christmas, and the first indication of that is going to be Prime Day. Yeah. If spending goes down in Christmas, if ultimately Tricia feels that her credit card has gotten so expensive, her auto loan is so expensive, her student loans that she now has to pay that she never had to pay before, is so expensive, I don't know where you're at, but in California, gas is like $6.50 a gallon.
It's
If
close.
gas is so expensive that I'm not going to spend $200 on Nikes, and instead I'm going to spend $40 on DSW shoes, inflation is going to start to come down. And so there's a lot of factors at play right now that weren't in the mix before, like students' debt having to come back to repayment.
Yes.
The average student debt is going to be $400.
Right.
Like on average, this $400 people never paid before, right? Or didn't pay for 3-4 years. So there's oil prices. I personally believe the unemployment numbers are skewed and aren't exactly right as they would. And the reason I think that is because, for example, we know that the actors union just came off of a strike, and then we have the auto manufacturers union on strike. Well, if you're on strike, you can't qualify for unemployment. Therefore, you're not counted on unemployment numbers.
No.
So I think there's a lot of data that isn't exactly accurate. And I think that, and there's a lot of economists that have said that, even some past Fed chairs that have said this, I think that the data itself is so fast that Fed is reacting to it in real time, while the impact in reality, in life, is slower over time. So this is what I mean. The Fed raises the rate, say, from the beginning of the year, X amount of times, a quarter of a percent. So somebody's credit card goes from 19 to 21 to 22 to 23%. It's going to take some time before that person stops spending that money.
Yes.
Goes back. But when that happens, it's a slam on the brakes to spending, which is inflation, which brings inflation down, which will bring mortgage rates down. I think that's what happens. I don't know. There's no crystal ball. But I think that there are so many other factors at play right now that haven't actually materialized in the economy yet that will create lower rates in the future. And what will happen is, I think, is that we'll have this slam on brakes. People are just going to stop spending money. Therefore, inflation will have to drop because of that. And then you're going to have rates drop. But then it goes back to the same circular problem. Inventory becomes an issue because builders can't build in a flash.
No.
Permit issued in the same day.
No.
Right. So I think that that's what happens. So again, a reason why, if you can buy today, you should buy today.
You touched on something I want to talk about, because not a lot of people talk about it and aren't even really aware of it, is the student debt. And for a long time, like years ago, you could defer that forever, and it really wasn't counted into a buyer's ability to buy. But now they had to start making payments October 1. How do you think that's going to impact people's ability to purchase? And explain that if you could, because a lot of people are very unclear about this.
Yeah, so during the pandemic, there was a state of emergency that froze student loan payments. You didn't have to make them at all. And in fact, the way the lending guideline works is that if those were deferred for at least 12 months, you don't have to count them into the debt anymore. And all that is changing October 1st, as you said. So let me illustrate it in this way. In 2000, 19, 20, 21, even 22, say I would see debt to income ratios in my clients of 45%, 44%, 43%. There's very rarely a case now when I see a debt to income ratio to qualify a loan that's not 48, 49%, because the mortgage rates are so much higher.
Yeah.
Add $300 to that. Add $400 to that. You're out. You don't qualify anymore for that home. Now you have to adjust your parameters of what you can afford, because that extra payment just broke that threshold of debt to income ratio.
So I know a lot of times in lending, people, like if you've got a late payment on your credit history at all in the last 12 months, you're out, like you're denied. People, I think, are going to either not be able to make their student loan payments or pay them late. Do you think that's going to negatively impact their credit and their ability to buy?
Oh, 100%. 100%. I think that there is a human habit of, I just don't have to worry about it and pay for it because I didn't for 3 years, or I never did. And it's not like they're getting phone calls about it right now. They got letters, they got communication, it's in the news. But if you're too busy living life and you didn't notice it, you won't notice it until it's too late. And then you're going to have to deal with late payments. And that will definitely impact your credit score, which then ultimately impacts your ability to qualify.
It's crazy because when you look at like COVID, when COVID hit, our world completely changed forever, I believe, where
Yeah.
there's just so many different dynamics that we have to figure out in the real estate world and in the lending world. I tell my agents, I'm like, not only do you need to be skilled at sales and negotiating in real estate, but you need to understand lending way more than you ever did. Yeah, you got to stay in your lane, but you have to understand about student loans and how does it impact your buyer. Maybe they can't even buy right now because maybe they owe $400,000 in student loan debt, and now that factored in an $800 a month payment. I don't know if they can afford to even buy a home right now, because when you're going to rent an apartment or rent a house, nobody's looking at that stuff. Purchasing is a whole nother ball game. And then
Yeah.
here in Texas, we are having a real dilemma with homeowners insurance. The rates for homeowners insurance is up 25 to
It's
30.
across the country. California and Florida are going through it as well.
Yeah. And so you guys, like, y'all are, I think you guys are even in worse situation than we are, because I know in the Florida market, I've heard that there's a lot of carriers that are pulled out and they're not even issuing new policies, especially on oceanfront property.
Yeah. Yeah. In Florida, you're really only going to deal with Citizens, which is the government issued insurance. And in California, because of regulation from the insurance commissioner not allowing insurance companies to raise rates, and insurance companies then argue, and maybe fairly or whatever your point of view may be, but they say, look, there's 1 billion natural disasters in California. We need to raise rates. We can't mitigate the risk if you don't let us. So if the insurance commissioner says, no, you can't, then they go, well, I'm out. It doesn't make sense. It's not good business anymore.
So then as a homeowner or a future home buyer, like, what do you do? Because there's a lot, it's complicated. Like, I don't even know that you can get homeowners insurance in California, and then your interest rate's higher. What has that done, all of this, to y'all's property values there? Because the news says, California is like falling off into the ocean, and property values are like down 40%. Is there truth to any of that?
Oh, no, not at all. I mean, California is still booming. I mean, it's still, we haven't seen a drop in real values. And it goes back to the same issue. And here, for example, in a lot of the municipalities is not easy to get permits. It takes a while. So that means that you can't build as fast as you want to. And we're overpopulated as it is. So that's why we have, I don't know what they call them there, but here we call them ADUs. I think they're called granny flats or something like that at different places. But you see so many garages getting converted into living space because there isn't enough space for people to live in. So no, I don't think that I would say California has an issue with property values. I mean, as a whole, I'm sure there's pockets that would be impacted, but as a whole, I think we're fine in that sense. And I think that that's probably the idea in almost every market in the country. You got to understand, if you lose value in an asset of 5%, insignificant. It doesn't matter. You know what I mean? And so it's like, if that's okay, like if 5% wouldn't make a difference, and we're not at 5%, we're probably +4 right now, year over year.
It's interesting to learn all of that because
at higher price points. So in Los Angeles, the average price of a home is $850,000. Okay. So if you're growing 4% on $850,000, you're doing okay.
Yeah, for sure. And then when you look at like here, their sales volume is down. Everyone's sales volume is down because the ability to purchase is not there for a lot of people. It knocked a lot of people out of the market. So we're seeing that overall. But then you have to look at the numbers. It's like, well, we're comparing it to COVID when that was like insane. Like, we had never seen that kind of a market before ever. So like, how do you make sense of all of that? And then how do you get back to a new normal, or what is the new normal?
You know what? It's a lot of what you and I talked before. You are so, I'm so impressed with the way you lead your team and the discipline that you carry the leadership of your team. And after you and I chatted last time, I spoke with a lot of other leaders locally, and that's what it takes to be a successful agent today and to be a successful leader today. I mean, it's gotta be a disciplined approach. And I get it, right? I work with agents, are my number one customer. That's my main customer. So I get that, a good amount of agents didn't come into this business because they wanted to be disciplined and work 13 hours a day, right? Yeah. I see that a ton in Miami. Like, they want to be at the beach half the day, every day. But the reality is that to succeed in this business, and by the way, it is an amazing industry. This is an industry that can give us so much. The CEO of Guarantee Rate, the company that I work for, says it all the time. So you can make doctor money, athlete money in this business. and dictate the hours that you work.
Yep.
And we happen to be in an environment where you have to work a lot of hours.
Oh,
But
yeah.
the erosion of the industry is also huge. So the other side of this is going to be very, very good in terms of market share for any loan officer or realtor that can stay in the business. Now, I will say this, and you touched on it before, you need to be versed in economics and you need to be versed in what's happening in the lending world as well. You don't need to be an expert. You need to be conversational. You need to be able to have the bullet points and the ideas of what is going on, so that you can guide your client correctly, and also so you can calm your client down when they think the sky is falling.
Yeah. And I know, like, there's a lot of people here in Texas. I'm in Houston. There's a lot of people that they're buyers. Like, we have a crap ton of buyers that are sitting on the fence. They believe, A, I'm going to wait till interest rates come down, and B, I think the market's going to crash and home values are coming down. I tell them, look, I'm going to tell you something. I don't believe home values are coming down at all. I think you need to buy now, because we can get you a sweet deal on homes right now, because a lot of homes are failing to sell. Are you guys seeing, when you're doing contracts coming across the board, are you seeing a lot of contracts come across with seller concessions for the buyer?
Yeah. And like I said, I think we have a pocket over the next quarter that we're going to get that from the seller.
Yeah.
So I think the summer and the hot, the hot season for sales, I think the seller was more like, no, not going to do it. Plenty of buyers. Not going to give you anything. But as again, we stay higher on these rates for longer, I think that the seller is going to have to realize they got to make those concessions and they got to help the buyer close the deal. And that's an advantage for the buyer.
Let me ask you your opinion on this. There's a lot of different opinions on the buy down. So a lot of people say, don't waste your money doing any buy down right now, because interest rates are going to come down naturally. I say, you know what? If you can get 15, 20 grand from the seller, use some of that to buy down your rate now, because we really don't know when they're coming down. What's your thoughts on that? And can you explain the buy down?
Yeah. So a buy down, there's two kinds of buy downs. A buy down, it could be either a permanent buy down, or it could, meaning when you're prepaying the interest rate essentially to lower that rate in a permanent basis for the life of that loan, however long you keep it. There's also the most common it's actually an old version that just resurrected because of the market, which is called a 2-1 buy down. And that essentially means 2 means 2% and 1 means 1%. Now, this is a different dynamic. This is really a subsidy, meaning in this situation, the buyer cannot pay the money. It has to be the seller that gives the money for it. And what it does is that the first year of your mortgage in a 2-1 buy down structure will be 2% less than what your actual rate is. So for round numbers, let's just say rate was 7.5%. Your first year, you're going to pay 5.5% for that rate. And your following year, you're going to pay 6.5% for that rate, for that loan, I'm sorry. And then the third year, you go back to your 7.5 interest rate. You have to qualify at the 7.5 rate. That's something agents sometimes misunderstand.
Yeah.
Qualify at the actual rate. Okay. But you get that advantage of that first year being, 2% less, the next year being 1% less. My perspective on it, if you're playing with house money, use it 100% every time. So if the seller's willing to do it and give it to you, take it. Yeah. Right. By the time that a year or 2 years pass, you're going to be able to refinance it to a better rate, permanently. It's an expensive proposition in most cases. So I think that if you're using your own money, maybe you got to think about it more, because it's not going to be, you already have closing costs.
Yeah.
And then you have whatever you need to do to the home to get it to your liking. And then you're going to add this on top of it. I'm not opposed to permanent buy downs, but maybe not, because when you're doing a 2% buy down, it's expensive to get the rate down. But you can use buy downs to buy the rate maybe 0.25% or 0.5%, and that's okay. But to go as far as equals, I don't think it makes sense if you're paying for it yourself. But if the seller's giving you the concession because they can afford it from their net proceeds from the sale, I would say take it all day.
I love that. Love it, because number one, people don't think about that stuff. And it's like, we have to show them creative ways, smart ways to actually purchase right now. And it's not going to fix. Everybody cares about their number one thing is, what's my monthly payment? That's what everybody cares about.
Yeah.
So it's like, here, we're going to explain this to you. Let me ask you another hot topic that most people aren't talking about, but I am very much talking about it. And that's the buyer's agent commission. As you
Oof.
know, that's a big hot topic right now, and it's going to be reformed, and things are going to change, and we're going to see a big change in 2024. So, as a lender, if a buyer's agent fee, we call them, is no longer maybe paid for by the seller, and perhaps that buyer wants to pay the agent's fee, do you think they're going to come out with a loan product that will include that?
It has to. It has to. I just came back from the NAREP convention for 4 days in Miami, which is the National Association of Hispanic Real Estate Professionals, and this was such a hot topic. Everyone was talking about it, and and again, it goes back to what we said before, that the business we used to know is not what it is, and it won't be in the future. We haven't even touched on AI and the stuff that's coming. I got to see so much crazy tech that's on its way at the convention. But as I think through that issue, I think that there has to be a loan component that will do that. But my concern is that there's no free money, right? There's no free lunches. So I think that honestly, how it's been done in the past is that ends up translating to rate and making it more expensive for a consumer, which I would say it's another argument for buy now rather than
Yeah.
later, you know. But I mean, I understand the spirit of it. I don't know that I like it. I get the spirit of it, but yeah, it's going to change the industry for sure.
It is. It's fascinating, and I feel sorry for the agents that are out there and not part of a company that understands this stuff and is focused on it, because it matters. Like, we have a lot to look forward to and to try to figure out in 2024, and it's happening fast. You just touched on AI. Like, what's your thoughts on AI and what it's doing to our industry, and what do you think it's going to do moving forward?
Yeah, I mean, I don't know if it was you that said it or who said it, but AI is going to be like Excel, like the internet, like a computer. The first adopters are going to win. Whoever
Yeah.
leans into it first is going to be the ones that win. You know, I think that it's just another instrument. It's a great instrument. I just think that you can't be afraid of it, because by the time you try to jump into it, think of it like social media, for example. By the time you try to jump into it, it's too late. You know, your competition has already become experts at it and knows how to manipulate it. And so it's something that you have to be taking classes, being educated on it, and find a way for it to fit your business.
Yeah. And I think when, like, just even with our conversation right now, I'm thinking of all of the stuff that if I'm a consumer, like, trust is a big thing. I would be scared to death to go online and apply for some kind of a loan or reach out to some real estate agent I didn't know. But based on all of this, because are you really talking to a real person? You may or may not be. Who knows? It could be AI. I think now more than ever, and even moving forward, it's going to really matter about us having relationships, with lenders and real estate agents, and then us having relationship with consumers, because they've got to be able to have that trusted advisor that's not going to take advantage of them and that can guide them down this path, because it's complicated.
Yeah, no, 100%. And in fact, the data is showing that. The data is showing that in professional services, the consumer is going back to the person rather than going into technology. But to be able to mix it in and use it as an instrument and as a lever to improve your business, that is important as well. You can't, you got to evolve with the times. Otherwise, you're just a dinosaur looking at a comet.
And for you, like, having your eye on 5 different markets, I think is fascinating. I think it's super cool.
Let me
And
tell
I
you
think,
about AI in the lending world.
yeah,
That's incredible. Guarantee rate right now, for example, has an AI home equity line of credit program. It closes in 5 days. 5 days. It doesn't. No human interaction at all. The software completely underwrites and approves the clients. And we're going to get to that point very soon in actual mortgages, especially agency mortgages like Fannie Mae, Freddie Mac type of loans, because tech is that advanced, and we can verify all the main things that we need to verify in seconds using tech. So the speed at which business is done is going to be even faster into the future, because deals are going to be able to get underwritten sometimes in a day, sometimes in hours, and you'll be ready to go, very quickly. So it's cool though, right? Because at the same time, it's an improvement in a process as well. Um, when you free up that time, the question is, are you using that time to connect to more clients? Same
Yeah.
thing in the real estate world. If you're using AI assistants to do XYZ things, you can't be at the beach then doing nothing. Like
No.
instead, you got to be using what is the biggest use of your time, and is getting your brand, getting your personality, connecting to people, being out there, right? And if you can use this tech to free up time and then use your actual time to grow your business, you're going to be in a much better position. You're going to grow.
I think it's going to eliminate, unfortunately, a lot of people's jobs because, like you said, they're not going
Yes.
to embrace it. They're not going to learn how to do it, and they're going to become obsolete. But I think it will make so many other jobs so much more efficient.
Yes. I mean, look, we went from conveyor belts to robotics to, I mean, this is just what we do as humans.
Yeah.
We evolve, right? But the thing is that you have to evolve with it. You can't just pretend like it's not happening, like it's happening. You know what I mean? There's
Yeah.
nothing you can do about the wave of technology coming through. There was a great demonstration about glasses that look just like my glasses, not a headset, like glasses. You put them on and you can tour a home anywhere you're at. Like I'll be sitting with you at a cafe and I'll be like, here, put these on, and you can tour a home and you move the screens with your hands. This room, that
Insane.
room, right? And you can
Yeah.
go, yeah, I want to go see it in person. Or yeah, I'll buy it. It's great. It fits my needs. I
That's
mean,
crazy.
the type of stuff that's coming out is bananas. You're gonna have a robot doing your open houses, showing you where to walk through.
I could see that happening. And that's crazy because we literally were just talking about in our sales meeting yesterday, what are the things that the robots can't take away? And one of the things we said was, well, open houses, you at least can have a human connection in the open houses. But there you go, robots taking over open houses.
I think a robot can't take away is you. It's your empathy. It's your energy, Tricia. The
Yep.
robot can't do that. The
No.
robot can't create the confidence that you create with your energy and your levels of experience and your years of experience. They can't do that. And here's
No.
why some of these big online lenders failed at these like do-it-yourself type of loans, right? Because what happened was, they were every client probably had 2 or 3 clients actually that did that for a refinance and came right back for their next deal to me. Because here's what the consumer ends up realizing: I don't know what I'm doing. I'm just clicking buttons.
Yes.
You know what I mean?
Yes. And
Because
it's like,
they don't have an agent saying, my daughter went to this elementary school. You got to talk to Principal
yep.
Sally. She is great. She bakes cookies every Halloween. Robot doesn't know that.
No. And, I think too, like when you go to the doctor, like you want to go to a doctor that is a specialist in something. Like if you have cancer, you're going to go to someone that's a specialist in cancer. Like if I'm going to deal with somebody in finance, I'm going to go to somebody who's a specialist. I'm not just going to, I believe I'm not, you shouldn't just go to some random online thing. But you know what? There's so many people that get distracted by that shiny object. Like, oh, look at this rate from, Joe Blow Mortgage and click on here. And it's like, they're never going to get you to the closing table, and you're not getting that rate.
Oh, then you're not, and you have no one you can even complain to. It's just like,
No.
So I think that's part of it, right? I think those two things go hand in hand. Like if you're going to have AI help you solve problems, then you got to put the work in getting your brand, your touch, your feel out into your community.
So when you look at because I know you're like me, like study this stuff like crazy. There's a lot of people that are fearful. They're like, I don't know if I'm going to be out of a job next year. What's your thoughts on the industry and your company and what you guys are doing moving forward?
Guarantee Rate specifically is a very innovative tech company. We released just this morning on our team called. They released a product, for example, called. Let me see if I can get it right. It's called Lock It and Sell It. Beautiful product. A seller is going to be able to lock their rate before they sell their home.
Really?
For 60 days is what it looks like right now. I think that we're going to see more innovation in both the fintech space and in guideline overall. You're going to see a growth of alternative lending programs that weren't as popular pre-COVID. Like, for example, bank statement loans or debt service coverage ratio loans or profit and loss loans, and you're going to see them being issued by major brands. Companies, names that you would know, like a Goldman Sachs or a JP Morgan. And so when it connects to the majority of your audience in agents is that you have to have a relationship with a lender that is so strategic and tight that you're both collaborating and working together on your cases, right? That's why I call them cases in my practice, because I look at it like everything's like a case. How do we solve this case, right?
Yeah.
Because if you just shut somebody out because they don't qualify conventionally, you don't really know, and this has happened many times in my practice, they may be willing to tolerate a higher rate to go on a bank statement loan because they want that house that much. I closed a $1.7 million deal in Florida, straight bank statement loan. That rate at that time, beginning of the year, was 7.75%. Crazy. That dude is under market today.
Yeah. He's loving life now. He's like, holy crap, I'm glad I bought when I did.
It's wild. And so the point is this. When you bring education and you have a consultative approach to a problem, you just don't necessarily know that buyer isn't going to be willing to do it. In fact, I had a thing where I did a post on, and this agent here in LA comes back and says, the market is eliminating home ownership for the people. So I say, what people? He says, for the Latino community. I said, really? I said, most of my deals right now happen to be Hispanic families. And he goes, how does that make sense? I go, well, they come together by generation and by culture. A lot of them live together anyways.
Yeah.
So maybe it's a piecing of, son works at whatever and daughter works at whatever, and mom and dad carry the heavier income, but all four together qualify.
I think it's just being creative
together.
Yeah. But you put it together, like you're thinking outside the box. Like, let's think of
you got to present these ideas to your clients. Would your son be willing to do it? Would your sister be willing to come in and help you? And the next year you help her, right? And then you start doing family wealth and you start changing generations by collaborating.
I love that you just said that, collaborating. We hashtag everything better together, because it's like, why are you trying to figure this out by yourself? Like, talk to somebody that's already done it, or let's figure it out together. We can make this happen. We can make this world better. I believe, like, one person at a time, one day at a time. It's just putting the right people together.
Yeah, 100%. But I think, again, when you take this approach as an agent, in a consultative manner, and you're following a process, and I know you're big on process, when you're following that process that is repeatable, that you do it all the time, and you cover a lot of bases, you're going to realize that there's more opportunity out there than you think on traditional, conventional approach.
I love your energy. I love your enthusiasm. I love your professionalism. You guys, like, he's been doing this forever. He's in 5 markets. I could just sit and pick his brain all day long, but I got to be like aware of everyone's time. Jose, tell everybody like how they can get a hold of you to learn more and ask you about these markets and everything.
Yeah, absolutely. And I welcome every email. I welcome every question. Even if I'm not in your particular state, I'm happy to give you any feedback that I can. You can email me at Jose, Jose Tejada, Tejada @rate.com. Probably should have put it on this thing. And you can find me on Instagram at Tejada Lending in Instagram, and follow me and I'll follow you back.
Heck yeah. You guys, I hope y'all have taken like a lot of wisdom. Walk away wealthy means walking away wealthy in wisdom and knowledge, because like, yeah, the world that we live in is complicated, and the real estate industry and finance is complicated right now, but that doesn't mean we're not doing business. We're still selling homes every single day. People are still qualifying for loans every single day. You just have to be with the right people that are guiding you. You have to be with those experts that are going to help you. And definitely Jose has got this thing down to a science and can get people into homes. Thank goodness.
Thank you. Absolutely. And thank you for having me on your show.
Heck yeah. Thank you for being here, Jose. You guys have an amazing day. Bye, y'all.